One of the reasons why people get into real estate is the tremendous opportunity for you to leverage tax savings through real estate. Today, I'm going to show you how to maximize your tax savings by treating your property both as a primary home as well as your investment property. Let's talk about using your property as a primary home. In tax code section 121, the 121 exclusion is that if you have lived in the property as your primary home for the last 2 years out of the last 5 years, as an individual, you could take advantage of a $250,000 tax exclusion. And as a married couple, you could take advantage of up to $500,000 tax exclusion. What does that mean? For example, if you bought your home years ago for $1 million and you sold it for $1.5 million, the difference between the two, in this case, is $500,000. You could walk away with it tax-free, not having to pay a penny in capital gain tax. As long as you live in the home as your primary home for at least 2 out of the last 5 years, you will be able to qualify for section 121 tax exclusion. Now let's talk about investment property. IRS either see a property as a primary home or investment property. So if you rent out your property for at least 2 out of the last 5 years, in the eyes of the IRS, it is an investment property. And when you sell the property, you are subject to capital gain taxes. What a lot of people do is they take advantage of tax code section 1031 and do what we call a 1031 exchange, which means that they are able to sell a property, rental property, and buy another one and completely defer that capital gain tax to a later time. However, there is a way to leverage the best of both worlds, treating the property both as a primary home and the investment property. And that secret lies in year 3. So, for example, if you own the property you live in for 2 years and then you later rented it out for 2 years, on the 3rd year, you could potentially take advantage of the primary home tax exclusion as well as rolling the rest of the profit into a 1031 exchange and defer your capital gain tax to a later time. Let me just use an example of my own property. I bought a property and live in it. I bought a property in 2012 and lived in it as a primary home until 2019. In 2019, I moved out of this home and I rented it out for 2 years. And in 2021, I decided that it's time to sell. And that was the year where I fulfilled both living in a home for 2 years and rented it out for 2 years. So in that year, the 3rd year of renting my primary home out, I qualify for both the tax exclusion as well as 1031 exchange. And that's exactly what I did. I took, as a single person, $250,000 tax exclusion, and I used the rest of the proceeds to buy properties as an investment property. And I successfully defer my capital gain tax obligation. So that's basically the framework of how to take advantage of the best tax savings in both scenarios. But do talk to your CPA about your specific situations. There may be depreciations that you took in your previous tax filings that needs to be recaptured. So talk to your CPA about that. And if you are interested in finding out about how to successfully use the 1031 exchange to double your rental income, watch this video right here where I dive into it in more details.